Hello, everybody. Thank you very much for joining this London Open Breakfast today, the first one of the new year. Now, let me just get my charts up really quickly and we'll get going. I hope everybody had a very happy new year. And, well, the markets have certainly got started off with, certainly with with what seems like a very, a very positive start to the year. Now, there are a few reasons for that, we believe. A couple of them is the fact that we haven't had any major debt auctions out of Europe yet. They don't really kick off in earnest. There's one in France tomorrow. But other than that, they don't really kick off in earnest, certainly not for the periphery, the places where we're really worried about until the middle of next week, really. Added to that, we haven't really had, we have been, it's the first week of the new month, traditionally a huge amount of economic data. We've seen some upside surprises to that data, so that could be another one of the reasons why, which actually makes the markets very sensitive to any downside surprises, but just to get that started. Now let me just put on this, I'll just show you a bit what price action is doing. Now hopefully you'll be able to see, you might not be able to. Hopefully you are able to see my euro chart. Currently on a daily price piece. If someone from the FX Street admin could just let me know if you can see that, because I haven't seen that come up. Right, you should be able to see me now. Oh, sorry, be able to see the chart now, the euro chart now. So as you can see, this is the daily chart to give you an idea. Give you an idea of the bigger picture here. Obviously back at lows last reached a year ago. As you can see here, MACD, daily MACD has turned up slightly, which is fairly positive. Now let's go back some. As you can see, we've been really trading in a very tight range. This was last Wednesday's move when the euro really fell off the cliff and dipped all the way down to that 128.59. But we're actually quite bullish euro at the moment, especially above that 130 level, really. We're above 129.95, which I just kind of bring to your attention. Let me just go back up a short bit here. 129.95. Oh, you can't quite see it, but 129.95 is where we like. It's kind of this kind of resting point here, just before it kind of shot up higher. So once it broke above here, then we did like it. Now, obviously, it has been capped on the upside at 130.80. It's looking like this decent resistance. It did try to get up there yesterday. It's currently trading about 130.64. We think if it does break above 130.80, then that opens the way. We then need to go to a bit of a more longer-term chart to 131.20 to start with. That 130.80 level, just to draw your attention to it here, that is a 21-day moving average. Sorry, I know I've been going backwards and forwards with the charts a little bit. You know what it's like when you just come back from or just started to do something again after a couple of weeks. But basically, yes. So what we've got here, 130.80 is the next resistance level of note. The high today has been 130.63. The high yesterday was 130.77. So it has been respected above there, as I said. Another short-term gain to 131.20. Now, that does not mean to us that we are gung-ho for the euro to make a huge, solid recovery, but we do just think in the near term. Now, I'm going back to the 15-minute chart, just so you can see kind of on a more, obviously, time down here, exactly kind of what's going on. But this, nice break higher here. We've seen a jump of about 30 points already this morning. It's kind of gone through a few decent resistance levels. Obviously, then that opens the way to that 130.80, then 131.20. But even in the long term, we're still fairly bearish. Let's go back to Willie. As you can see, really, since the holidays began, really, 131 has really been the high. So we're talking about kind of very short-term gains. Probably 131.20 has been the high, and that's what we're targeting. So we think it's going to take a big push to get above 131.50. It didn't manage it before we all broke away for the winter break. But as you can see there, if I could just draw a trend line for you as well, still looking fairly weak. That's not a perfect trend line. Let me just try again. It's still looking fairly weak on the euro-dollar side of things on the longer-term picture, but on a shorter-term picture, it's looking fairly constructive. And now what we could see is this kind of hitting 131, 130.80 and then bouncing back again. We need to see a clean break of that 130.80 before we can even begin to target 131.20 or 131.50. And in the current environment, I'm not very confident at making kind of longer term assumptions than that. I think right now, the first week back in January is always a little bit strange. Volumes certainly haven't been picking up. Volumes still remain very low. There isn't too much going on, as I said. A lot of the kind of real government actions don't take place until next week. Added to that, we don't have the next EU summit until until the end of January. So there's a lot that could scupper the euro between now and then. So in a very short-term basis, I'm bullish, but don't take that as a wrong way to suggest that I'm bullish all the time, because I'm not. Right. Let's take a look at something else that's been fairly interesting. So I'm going to take a look at the yen chart. Obviously, since we've come back in, we've had a few things that have really moved the markets. We've had a global manufacturing data come out. In China, it went back above 50. Now, it was a very positive, or it was a more positive number than expected. And then, obviously, we had the fastest pace in the US ISM growth for 6 months. So that was the US manufacturing ISM, surprised on the upside yesterday. Has some very strong fundamentals, has some very strong forward-looking indicators which suggest that could continue to do well going forward. And really helped push forward that rally that we saw yesterday. We basically saw the manufacturing rise to 53.9 from 52.7. Apologies there. 1 second, let me just pull my chart back up again. But the reason why I bring that up whilst mentioning dollar yen, it's all gone a bit pear-shaped here. There we go, much better. The reason why I bring that up while showing you dollar yen is that usually stronger data out of the US should push up treasury yields. But when treasury yields, the 10-year treasury yield and dollar yen tend to have a very good correlation. But as you can see, dollar yen is still looking particularly weak. So the dollar has continued to actually do quite badly versus the yen. The yen obviously being your safe haven of choice. Now we are again kind of below 77. We think this looks particularly weak. So that is the 100-day moving average. That's the yellow line on this chart here. That's about 77.04. But below here, we think it looks quite weak. Obviously, the low is below that kind of 75 level, really in the intervention territory in this kind of band here. Haven't heard anything from the Japanese authorities. Obviously, Japan has been out on holidays until today, and volumes were still notably thin there. But what is it doing on a more shorter-term basis? As you can see, it's more of this kind of slow grind lower. And what does that mean to us? Well, that means to us that we could essentially see some further weakness. And the reason why I say that is because the Japanese authorities don't tend to react unless we see something that's really unless we see volatile moves, essentially. So below here, we would kind of target. Just bear with me while I pull this up again. So again, below kind of that 77 level, below 76.80, we would really target kind of 76. Let me just bring that up there. We would probably, I'm going to have to go on a longer term chart because we really are at unusual levels. Below 76.80, we would then target 76.55. So we're getting very close to this level here, and this kind of is around and about a clear break below this resistance line here, which I'll just draw in. So that's what we'd be targeting. to see further losses then to around the 76.30 mark, stroke 76.20. Now, we would argue as at kind of below 76.30, we could be, we're moving into very dangerous territory. We're really moving into intervention territory for sure. So you really, you've got to be very, very careful when you get around these levels. So we would expect, this is the longer term chart. I'm now going to go back to the 30-minute chart. As you can see, the dollar yen doesn't really move in dollar yen doesn't really move in terms of in big movements often. It goes through vast periods of kind of trading sideways. I'm going to go back to that daily chart just to show you that. So as you can see, it can often trade sideways and then have a move down, trade sideways, then have a move down. Now, it's had such a big move down, and that break of the 77 level is so significant that we think could be more of a slow grind lower. So as you can see here, slow grind over the last, well, since the start of the year, really, rather than any big move. Now, partly that's because people have obviously been on holiday. Now that people are back, there could be another slow grind lower to that 76.30 level, but be very much aware of dollar yen that we could easily see a sharp move higher, especially as Japan comes back on board, because we are moving into this intervention risk territory. So above here, if we were to see a sharp move higher, we'd obviously target 76.80 and then 77.10 as our next targets. As you can see, the MACDs on the shorter term chart aren't really telling us anything. Let's take a look at the hourly. Again, kind of moving sideways, so it's this kind of your traditional dollar yen story. And now let's take a look at the pound as well. I'm just going through kind of everything. For some of you, it might be your first day back or your first, your week back into trading. It's quite good just to go through a few things. The pound, funnily enough, moving along nicely. This is just to show you kind of let's take it through the stages. So the longer term chart, it's bounced nicely from below 154. It had a nice bounce higher. Certainly on the hourly there, it's looking very, very strong. We like it above kind of 155, 50, 60. So that was kind of around here, this kind of cluster of hourly SMAs, and this kind of low here. Once it had a clear break above there, which it did yesterday, of course. It's actually done very well. So it's now currently testing kind of 156, 50, 60 area. Above there we see 156.75 and then 157. So again, doesn't necessarily, we have had a lot of movement already. We could see a little bit more going forward. Let me just tell you what economic data we've got coming out today. We've got some PMI construction that doesn't tend to move things, but if we were to get a much larger number or a much weaker number, it could cause it to come off a little bit to just re-enter more longs. And we've also got some mortgage approvals and M4 money supply. Again, the data today is probably a little bit, they're not your traditional market movers. We have to wait for the PMI services data tomorrow, so things can kind of tread water a little bit until then. We could meander back towards that 157 level, but we do think 157 will be quite strong resistance. But then saying that, any kind of dip, the pound has done really well over the last, certainly kind of from the middle of last week onwards, really. It fell along with the euro. It's still very much moving with what's going on in Europe. And being led a lot by the dollar crosses, but while the dollar is weak, this is very beneficial for the pound. So the dollar has started weak again today, so do note that. The other cross that I'd like to bring up for you is euro sterling. Euro sterling is looking very bullish. As you can see, the focus very much kind of on 83. Now this is a 60-minute chart. It's been very, very volatile. Let's just take a look at it here on the daily, and you can really see we are getting stuck very much around this kind of 83.30 zone. As you can see here, that's been good support. We did break down or test below it, didn't like it, back again. In periods of kind of risk on at the moment, because we are so hard, so the market is kind of so harshly figured around periods of risk on and risk off. What we are tending to see is that in a risk-on scenario, the euro tends to outperform the pound. On a risk-off scenario, and then the pound will outperform the euro. And we've had more risk-off than we have had risk-on, and that is why we've seen that very large collapse in euro sterling. The one thing that I would also point out, though, is that overall, we're not fully convinced that this is going to be a rally and this is going to how we start off and things are going to be fantastic. There's a lot of unknowns out there, so our bias is still to sell euro sterling on rallies. So again, if we were to see back towards that kind of 83, kind of this 83.70 zone, we'd look to sell it because it does seem to be range trading. And the range at the moment seems to be kind of 83.65 to 70 with 83.20 on the downside. But we do think that we could eventually go and test that kind of 83.05 area, which is a really key, not only is it a key support level, but it's a psychologically key support level. Added to that, if we were to break below there, we could potentially see to 82.80, around about that level, which is the January 2010 low. So let's go back to that daily chart just to show us that. So there we go, kind of 82, well, that's not exact, but say 82, 80, 85 area. That could be the low that we see, and then below there, we'd need a really kind of good push, because then it would have to go and kind of take us, would have to go even longer, really take us to kind of that 84.50 level. But this is basically what euro pound looks like on a weekly chart going all the way back to 2007, which is sometimes interesting to see, because it doesn't look half as choppy as this one here looks. But we would, so, very much in the short term, we think about anything above kind of 83.65 to 70 is worth a sell on euro sterling, with 83.20 on the downside. Now, something else that I liked at the start today, or at the start of this week, my week started yesterday, was euro Swissy. The reason why is that we've got some inflation data out of euro Swissy. Let me push that chart up because it's a bit confusing, isn't it, looking at euro sterling when I talk about euro Swissy. I liked euro Swissy. I put on trade at about kind of 121.65 yesterday, which happens to have been around about the low today. But euro Swissy, the reason why is because we have got, it's kind of a mixture between kind of technical but largely fundamental. My euro Swissy dislike dislike of further Swissy strength. So the reason why is, as you can see here, let's take a look at the daily just to give you some background. Obviously, euro Swissy is pegged, right? So it doesn't, it shouldn't move below 120. It's been pegged since September, and it hasn't moved below 120 since then. Now, we got to a low of about when we kind of hit 121.50, I started getting a little bit concerned, because we do have some inflation data out of Switzerland on Friday, which is expected to show that the country fell into, or is still in deflation. That's one of the reasons why the S&P put the floor in the first place. I think it's going to keep them, if we do get this, we're a very weak reading of inflation. So if we are to see the country is deep in deflation, and then it's really going to push the S&P to take more aggressive action to weaken the Swissy further, and essentially that could obviously that would push up euro Swissy. We'd kind of target certainly to start with, obviously 125. Well, to start with, certainly on a short-term basis, kind of target this 122.50 zone, cluster of daily SMAs. And then kind of even potentially depends how harsh they are, but you could even think about targeting something higher, so going towards that kind of 125 zone, which has been a high since September. Again, they might not come in. They certainly didn't on the 13th of January when they had their last policy meeting and up the floor. We're not necessarily saying they're going to do that, but they are going to be very worried about, and very aggressive, we think, at keeping this floor in place. Now, add to that, we had some ISM data out of Switzerland yesterday, which was very strong, which showed a pick up in export orders. So it does suggest that this floor is having a good effect on the economy, but it's still too early for them to think about taking their foot off the pedal, if you like. So they are going to have to continue to aggressively pursue that. So I am looking for a stronger euro Swissy. As I said, I got in about 121.60 level yesterday. I'm keeping a fairly tight stop around that kind of 121 mark. And again, as I said, targeting 122.50 to start with, and then looking for further gains or further grind higher. So this could be a longish old trade, but I am very much looking out for what happens on Friday any word from the SNB between then and now, but I think that we're going to get some strength priced into Euro Swissy. Added to that, obviously the overall environment, as long as if we continue to remain in this kind of fairly benign environment, that should also be fairly good for Euro Swissy, because obviously Euro Swissy is kind of your ultimate sell when during risk-off periods, or traditionally is your ultimate sell during risk-off periods. So as I said, support, the next resistance level, 122.55-ish, there or thereabouts. With support at 121.26. Again, I just gave myself a bit of a wider boundary there because obviously I like this trade for a bit of a longer term thing. Now, I also want to show you Aussie dollar. Aussie has been, obviously it's the kind of risky end of the FX spectrum. It's done very well. It tested its near-term resistance at 103.80. That was a key move actually for this pair. So let's go back to just the daily chart here. So as you can see, it's looking really good. That break above kind of 103 resistance here suggested that it was, a nice little uptrend there. Just draw your attention as well to the daily MACD. That's also higher. Obviously, the next target, kind of above 103.80, as I said, is then kind of 104.20, which is the 200-day moving average. So a really key resistance level that you need to watch out for there. As I said, still looking quite nice. Now, one thing I would point that obviously that 103.80 has been near-term resistance. It did come off it, certainly in the near term, and as you can see, the MACD did turn lower. So we really need to see a good clear break of 103.80 before we target 104.20, the 200-day moving average, then 104.50. So right now it's hitting a bit of stickiness. I think that's because obviously we have had big moves since the start of the year already. I mean, we opened on Tuesday at 102.48 and we closed at 103.85. So that's 150 pip move, so we could see a bit of stickiness before we break again. But do watch there. Obviously we will be keeping our eye on it. Now on a more shorter term basis, as you can see, it's going up to trying to retest that 103.80 level. So that's kind of what we're seeing. So on a short term basis, it looks like we could go up another kind of 20 points or so to test that 103.80, but then it could get very sticky and it could come down again. As I said, it could actually be a bit more worried, or a bit more, or not a bit more worried. It could actually be just a bit, investors could be a bit more cautious. Maybe as we head into that French debt auction tomorrow, maybe just because we've had such a big move already. So we would expect some stickiness around 103.80. Whether or not we get back above there is whether or not this environment can be sustained. The Aussie isn't really moving on its own fundamentals. There's still so uncertain out there. It's moving a lot more on whether or not we've got a kind of an overall good environment, as long as that we don't get any downside surprises, for example, from from Europe. That would be the key thing to look out for. Now just the last chart I want to show you, just bear with me, I'm just going to have to pull it up here. Now, one thing I do want to show you is this chart. Now, this is a Bloomberg chart, so it doesn't represent the prices offered by Forex.com. But the white line is the DAX, the German DAX index, and the orange line is the S&P 500. Now, the reason why I bring this to your attention is because traditionally, let's go back a bit further, even to 2008. They tend to move sort of in the same direction. They can have peaks and troughs. They can have periods where they diverge, but then they can kind of come back into play together. And the reason why I say this is because essentially the reason why they don't always move in tandem with each other is because Europe tends to follow the US economic cycle, but with a lag. As the US is doing well, Europe can still be struggling, but the fact that the US is doing well can sometimes be good news, certainly for Germany and for the big exporting nations of Europe, which of course Germany is the leader of, the king of. So what we've seen, if we just go back to a more kind of shorter time frame, what we've actually seen here is the US economic data start to turn higher. We've had some fairly positive data out of Germany as well, especially on the employment front. But when the US is doing well, that does bode well for somewhere like Germany. And the reason why I say that is that US economic data points to a good manufacturing recovery. It should be good news for the S&P stock market. What's good news for the S&P will eventually be good news for the DAX. So even though the DAX is pointing lower, the S&P is pointing higher. They're diverging at the moment. We tend to think that that actually what's good news for the S&P will be good news for the DAX with a bit of a lag. Now, how long could that lag last? Well, it could last a couple of months, but just I would just be aware. Obviously, stock market pricing in very, very quickly. Obviously, there's a lot more uncertainty these days because of what's going on in Europe. But potentially, what we could see if we continue to see a strong US in this first quarter, and it looks like Europe isn't going to blow up, then that could be good news for the DAX. So this is something just to keep your eye on, and I will bring it back to you. But it could essentially mean the DAX, after having fallen, by over 10% over 2011, could actually start to do well. Now, the US is Germany's second largest trading partner after China. What's good for the US is generally quite good for it's generally good for the overall kind of global demand story. Now, whether or not that can be kept up, we don't know yet. We need to see some further strong economic data. So let's take a look at that. But this is just something to watch. Now, someone said, is an equity bull coming in the coming weeks? Well, I think that's kind of the wrong way to put it, actually. I'm not necessarily saying that equities are going to start and completely act as if nothing happens. They're still going to be very vulnerable with what goes on in Europe. We've seen some very weak data out of Europe's periphery. It looks like Europe is still in a mild recession, but potentially, if it seems like it's coming out of that, if it looks like the Europe is going to avoid an overall collapse, then some people may argue that actually European equities have kind of been oversold, and they could come off some. They could essentially start to do a bit better. And they could start to do a lot better, actually. Now, if there's any questions, please let me know. So I'll leave you with a picture, a 15-minute chart of the Aussie, just to show you that it is, running into a bit of stickiness at this 103.65, 60 area. That is certainly worth looking at. But anyway, thank you very much, all of you, for joining. I hope you found today useful. And please do join me on Friday morning, where I'll take a look again at that DAX and that S&P, because that chart wasn't actually right. I do apologise, but it gave you kind of a similar-ish idea. Brilliant. Thank you very much, everybody. And I'll see you on Friday.